These past few years, we've been through a lot of struggles. With the current pandemic, surely everything's been so tough for the majority. So tough that the Federal Reserve has stepped in to wind up that money printer to assist individuals and businesses get by such unsteady times. Don't get us wrong, surely a lot of people definitely needed this type of economic support and we're glad they received it. But let's refer to the words of Warren Buffett. When it comes to economics, you can't just do one thing. You have to ask, and then what? Now the sad truth is that the huge expansion in money supply in the United States keeps the interest rates at zero. However, there's a fair bit of inflation. This does not simply mean making a carton of milk or a tray of eggs expensive. This goes beyond that, and this inflation can also be seen in asset prices like real estate and also in the stock market. The median house price in the United States has risen 16% in the last year, and the S&P 500 has risen about 36%. But here's the thing, if inflation gets too hot, then the Federal Reserve will take matters into their own hands and will raise interest rates. This serves as brakes for the economy. This results in loan repayments becoming more expensive. It makes newly issued bonds more inviting for big investors, and as a whole, it would bring asset prices like real estate back down. The Federal Reserve saw this coming, and they've actually admitted that rate hikes could come as soon as 2023, after saying in March that it saw no increase until at least 2024. However, if the inflation gets worse, then that timeline will get thrown out the window and rates will immediately go up. Now, we're not psychics that can predict the exact time of the next recession. However, the indicators are there, and being prepared never hurt anybody. Fortunately, there are steps you can take to shield the bulk of your assets from a market crash or even a global economic depression. Let's go through each and one of them in order to prepare yourself for the next market crash. Keep some cash available to invest. The great investor Shelby Davis once said, "You make most of your money in a bear market. You just don't realize it at the time." Anyone who bought stocks in late 2008 or early 2009 can attest to this. So it may be sensible to keep some cash on hand to go bargain hunting during declines. Of course, as noted above, this step should be taken only if it allows you to remain within your desired asset allocation range and risk tolerance. Bear markets can create pain, but they also bring opportunity for the well-prepared. Investing with the knowledge that corrections can be severe and violent will reduce your emotional response. This will help you keep a clear head about strategically investing and accumulating positions at perhaps even more favorable entry points. And if the emotional roller coaster of investing is just too much for you to get your arms around, seek out a trusted, knowledgeable advisor who can help guide you through the tough times. Diversify. Diversifying your portfolio is probably the single most important measure that you can take to shield your investments from a severe bear market. Depending on your age and your risk tolerance, it may be reasonable for you to have most of your retirement savings in individual stocks, stock mutual funds, or exchange-traded funds. But you need to be prepared to move at least a good portion of that money into something safer if you see a crisis looming. Individuals these days can put their money in a wide range of investments, each with its own level of risk. Stocks, bonds, cash, real estate, derivatives, cash value life insurance, annuities, and precious metals are a few of them. You can even experiment in alternative holdings, perhaps with a small interest in a producing oil and gas project. Spreading your wealth across several of these categories is the best way to ensure that you have something left if the bottom really falls out. Get a guarantee. You probably don't want all of your savings in guaranteed investments. They just don't pay off well enough. But it's wise to keep at least a small portion in something that isn't going to fall with the markets. If you're a short-term investor, bank CDs and treasury securities are a good bet. If you're investing for a longer time period, fixed or indexed annuities or even indexed universal life insurance products can provide better returns than treasury bonds. Corporate bonds and even the preferred stocks of blue-chip companies can also provide competitive income with minimal to moderate risk. Remember your appetite for risk. Even though the stock market has its roller coaster moments, the downturns are ultimately overshadowed by longer periods of sustained growth. That's the reality on paper, so try to keep today's storm in context. If only our brains accepted that and didn't trigger emotion-driven reactions like selling during market dips and possibly missing the eventual uptick. Investing in the stock market is inherently risky, but what makes for winning long-term returns is the ability to ride out the unpleasantness and remain invested for the eventual recovery. You'll be able to do that if you know how much volatility you're willing to stomach in exchange for higher potential returns. Ideally, at the start of your investment journey, you did risk profiling. If you skip this step and are only now wondering how aligned your investments are to your temperament, that's alright. Measuring your actual reactions on times of distress will provide valuable data for the future. Just keep in mind that your answers may be biased based on the market's most recent activity. Hedge your bets. If you see a major downturn ahead, don't hesitate to set yourself up to profit directly from it. There are several ways you can do this. The best way for you will depend on your risk tolerance and your time horizon. If you own shares of stock that you think are going to fall, then you could sell the stock short and buy it back when the chart patterns show that it's probably near the bottom. This is easier to do when you already own the stock you're going to short. That way, if the market moves against you, you can simply deliver your shares to the broker and pay the difference in price in cash. Another alternative is to buy put options on any stocks that you own that have options or on one or more of the financial indices. These derivatives will increase enormously in value if the price of the underlying security or benchmark drops in value. Stay invested for the long term. As the old investment proverb goes, time in the market is more important than timing in the market. It is impossible for anyone to know exactly when share prices might rise or fall, so investors should remain focused on their long-term objectives, rather than trying to guess when a correction will occur. Adopting a buy and hold strategy means that you stay invested throughout the market cycles, helping prevent you from making any reflex reactions during turbulent times, which could mean you sell at just the wrong time. As you're holding your investments for the long term, it also means you'll pay less in fees as you're making fewer transactions. Of course, no investment approach is without its downsides, and there are no guarantees that you'll end up with more than you put in. But the hope is that sitting tight during periods of volatility will pay off over the long term. Invest regularly. Drip feeding your money into the stock market means you avoid the risk of investing a big lump sum just before a market correction. It also means you invest across a range of prices, so if there's a correction, your money will buy you more shares and less when it recovers. This means you effectively pay the average price over a fixed period, which can help smooth out market volatility. Again, there are no guarantees that investing regularly will leave you better off. You could face the reverse scenario and end up with a loss, but it can help introduce investing discipline as you'll invest regardless of whether the price is high or low. While there can be benefits to investing regularly rather than as a lump sum, you should remember the impact fees have on your investment. If you're only investing small amounts each month, the minimum monthly fee can make it expensive and may exceed returns. Pay off debts. If you have substantial debts, you may be better off liquidating some or all of your holdings and paying off the debts if you see bad weather approaching in the markets. This is especially smart if you have a lot of high-interest debt such as credit card balances or other consumer loans. At least you'll be left with a relatively stable balance sheet while the bear market roars. Paying off your house or at least a good chunk of your mortgage can also be a good idea. Minimizing your monthly obligations is never a bad idea. That's about it for today. We hope this video helps you weather financial storms in the future. Consider hitting like and subscribe, and we'll see you on the next video.